Right now, retail investors are terrified of missing the AI infrastructure wave, and that fear is driving a massive surge in market momentum. At the center of this frenzy is Vertiv. They supply the picks and shovels for the AI gold rush, the physical plumbing and power systems that keep modern data centers from overheating. Over the last 12 months, Vertiv stock is up over 150%, riding momentum into an S&P 500 inclusion. But at $318 a share, you're paying 75 times trailing earnings and 48 times forward earnings. But the underlying company is undeniably strong. They have a record $15 billion order backlog, delivering organic growth north of 30%. And that sets up a brutal decision. Do you pay peak cycle prices for a high-quality hardware company, or are you walking directly into a valuation trap? The business case for Vertiv is built on a physical constraint. Nvidia's next-gen processing platforms require massive power and generate immense heat. Traditional data center air conditioning is useless for a 132-kilowatt AI server rack. You have to use direct-to-chip liquid cooling. Vertiv builds exactly that. They design the mission-critical liquid loops, coolant distribution units, and high-density power switchgear installed right in the server aisles. Meeting this specific hardware requirement has handed Vertiv an oligopoly-level share of all physical infrastructure spending. The trade-off is extreme exposure. 80% of Vertiv's total revenue comes exclusively from data centers, and the demand pipeline for those data centers is controlled almost entirely by a few buyers: Google, Meta, Microsoft, and Amazon. The company is exceptional, but your investment is entirely chained to the capital expenditure budgets of just 4 tech giants. That brings us to the math. Vertiv currently commands an enterprise value of roughly $125 billion. At 48 times forward earnings, Vertiv is incredibly rich. Legacy peers usually top out around 25 times. Vertiv even trades higher than Nvidia. You're paying a steeper premium for plumbing than silicon, while your free cash flow yield drops to a meager 2%. The market has priced this stock for flawless execution. Vertiv has to hit its long-term target of 25% operating margins just to justify the premium you are paying today. Buying a stock priced for perfection brings the threat of multiple compression. If investors decide the premium is too high, the stock price gets crushed. A single missed earnings target, a delayed hyperscaler project, or rising tariff costs will trigger that re-rating instantly. Buying right now means taking on maximum financial risk. You are completely divorcing the quality of the underlying company from the safety of the math. We also have to look at the history of physical infrastructure. This is a sector known for aggressive boom and bust cycles. Right now, we are in a massive infrastructure build-out, but eventually, hyperscalers hit a phase called CapEx digestion. They pause new orders to actually install and optimize the billions of dollars of equipment they just bought. This graph demonstrates the lag effect. Physical hardware has a long lead time, so reported revenue keeps climbing even after new orders dry up. If order velocity slows, the multiple will compress, and this stock could easily drop 35%. And right as the debate over this exact cycle risk reached its peak, management made a concerning decision. They stopped releasing their quarterly order and backlog data to the public. Removing that specific data point strips away the most important leading indicator of a cycle top. It blinds investors to the real-time health of the demand pipeline. Buying NAND at peak valuation while management reduces transparency forces you to rely entirely on momentum instead of verifiable demand math. So let's map out the actual risk-to-reward ratio for a 2-year hold. This decision matrix plots out our probability-weighted expectations. Our base case points to a 13% upside, but if the cycle turns, the bear case is a severe 43% downside. You have an exceptional business, but extreme valuation risk. We can set specific entry zones. First, the red zone. Do not chase this stock above $340 under any circumstances. If you want exposure now, cap your position strictly at 1% of your portfolio within the current $300 to $318 range. Keep it small. For value-conscious investors, let the market's natural volatility do the work. Wait for a pullback between $255 and $285. You also need to monitor the thesis breakers. If you see the book-to-bill ratio slip below 1.0, or if a major hyperscaler cuts their 2027 CapEx guidance, you walk away entirely. Excellent investing requires tactical patience. You have to wait for the optimal moment of vulnerability before you commit your capital. Vertiv will likely be a highly successful supplier for AI infrastructure over the long haul, but right now, the stock demands perfection. Let the cycle hand you a discount.